Okay, first segment. Explain it like I'm 5, or as we've discovered, maybe explain it like I'm 15, 16 by the time we get to the end of the topic. Today's question is something that maybe a lot of people who are interested in personal finance may have asked. What are bonds?
Bonds are that are so unpopular right now, but you hear about the word. You hear the word stocks and bonds. And I
Mm-hmm.
think we'll do another episode where we talk about stocks. We talk about stocks every episode, but what is a stock? But some people, I think, don't even know what a bond is, very reasonably, because why would you? Like, do we have the bond class in high school? No. That's why you're listening to the Personal Finance Club show.
Mm-hmm.
And in the world of investing, I think, is often the headlines are about very speculative things. What's the price of gold going to do? Crypto, meme stocks, oil. This is speculating what's going to happen in the future. Bonds are not very speculative because this is what a bond is. A bond is a loan. It's like giving someone a certain amount of money, a loan, for a certain amount of time, a term, and they promise to pay you back. So like, let's say, Jen, you want to go buy a new Bob stroller because
For
just in
my
case,
non-existent kids.
just in case you have kids one of these days and you want a $500 Bob stroller. And so you say, hey, I'm going to sell a $500 bond. And that basically is like a little piece of paper that says, I promise you, I'll pay you back $500. So I give you $500. You give me back this piece of paper that's the bond. And then you say, I'll give you the money in 5 years from now, like after I've had kids or something. And so the term is 5 years. And so what happens, that's a transaction. You give me the piece of paper, which is the bond. I give you the $500. You go buy your stroller, do whatever you want. And then 5 years later, I can take this bond that says on it, good for 5 years until a certain date, and give it back to you and say, hey, give me my $500 back. And you do. That is like the transaction of a bond. That's part of it. And you might be asking, okay, why would anyone do that? Why would someone just loan their money away for free for 5 years to get it back? And the answer is they wouldn't, because during that 5 years, there's also a rate on this bond that says, hey, every month I'm going to pay you a certain amount of interest. The rate might be and it might not be monthly, it might be quarterly or yearly or whatever it is, but I'm going to pay you a certain amount of interest per year. Maybe it's 3%. So that means 3% on $500 is what? $15, right? Yeah, I did that math right in my head. No calculator. Look, here's my hands.
Come
And
on, math.
so that means every year you're going to give me $15. So I give you the $500. You give me the bond, and then every year you give me $15. And then at the end of the term, you give me my $500 back. And so bonds are a way to basically put your money to work to be making money for you just so it's not sitting there in your checking account doing nothing. You know, these days bonds are paying sometimes more like 4 or 5, 6 or 7%. 3% would be pretty low. Historically, like a few years back, it was more like 3%. And that's what it is. They usually come in $1,000 increments, not $500 increments. And they're usually not sold by people. They're usually not sold by Jen trying to buy a stroller. They're usually sold by governments or companies. And so the federal government, for example, sells lots of bonds. That's one of the ways they fund the government. That's the way they, pay back previous interest and do all these things that the government needs to do. And so they'll sell these $1,000 bonds. So a rich person could go to treasurydirect.gov, look through the list of bonds for sale and buy them. And they would own them and they'd give the money and they'd get the payments over time. They'd get all their money back. And that's instead of a speculative way to make money, instead of hoping gold goes up, instead of hoping Bitcoin goes up, instead of hoping oil goes up, that's a very responsible, conservative, safe way to make money. And basically all investors believe that the US government is about as safe of an investment as exists because the US government has the power to make money and the power of the US military, yada, yada, yada. And so you're pretty confident, these days with the headlines you read in the news and the government being shut down and things like that, maybe not. And the reason the government's shut down is because, the Congress has refused to agree upon a way to keep paying back all these bonds, paying all our bills, right? But that's what a bond is. It's just a loan. You buy the bond, you get the piece of paper, and it's not a piece of paper anymore. It used to be. Now it's all done digitally, of course. You get your entire amount back at the end of the term, then you get paid along the way. And you can also trade these. So like, let's say you buy a bond with a 10-year term. 2 years in, you're like, okay, I want my $1,000 back now. You can sell it to someone else for about $1,000. It might be a little bit more or a little bit less based on what rates are doing along the way. But these things trade all the time. And, we're beyond 5-year-old explanation territory. But what normal investors do, like individuals like you and me, is we're not really going to treasurydirect.gov to buy individual bonds. It's just logistically inconvenient and complex. You're probably buying an index fund or a mutual fund or an ETF that owns a zillion bonds inside of it, and it automatically is collecting those payments from the issuers and is automatically, renewing them over time and buying and selling them as like the fund needs. And so you can basically get all the benefits of bond ownership, that growth of the income over time and the return of your capital without having to go manage them directly.
I love it. I feel like a couple of things that I've learned since working at Personal Finance Club. It's actually very educational to work here, by the way.
Oh, good.
In case anyone was wondering.
You want a job. We don't have any, so.
We have exactly one position, and I have it. I've learned that bonds are going to return a bit more than a high yield savings account usually, but less than the stock market. And that as you get older, you're probably going to want to invest more in bonds because they're more stable. They're, as you said, the government, we don't really know what's going to happen, but most likely you get a guaranteed return percentage as opposed to something fluctuating. So those are two things that I've learned from you directly.
100%. And young people, this audience is probably mostly young people. I think the typical listener is a millennial-ish, or maybe Gen Z-ish. And so the people hate bonds right now because rates have dropped, or rates have went up a lot the last few years. And when rates go up, existing bond values go down. So if you bought bonds 5 years ago and you paid $1,000 for your bond, no one today wants to buy your crappy bond from 5 years ago because your bond didn't have a very high rate 5 years ago because rates were lower. So as rates go up, as they just have over the last 5 years, the existing bond values go down. You can always just wait. You can just wait out the rest of the term and get all of your money back as is guaranteed by your bond. But if you're trading bonds and you're watching the value of your bonds, like on your investment website, you're going to see that they went down temporarily. But they'll come back. And the opposite is probably about to happen as rates have just started dropping. And if they continue dropping, all of the existing bonds will go up in value. And so I kind of think that as goes pop culture and investing, the opposite is generally what is the right thing to do. And so right now, crypto, NVIDIA, big US tech companies are super hot because they have been the last 10 years. But is that what's going to be hot the next 10 years? I doubt it. I think we could be doing we're doing about 50 of these per year times 10 years. We could be doing episode 600 in 10 years from now, Jen. And we could be having the opposite conversation about how bonds were the hottest investment for the last 10 years, as crazy as it sounds.
Right.
But basically what you said is exactly right, which is people in their 20s, 30s, and really even 40s are like much more aggressive. Like, yeah, I want to buy the hot thing. I want to get really big. But when I talk to people in their 60s, 70s, and beyond, what they really want is to not lose the principal. They want to not lose the money they put in, which is what bonds are good for. They just generate income. They just pay you those coupon payments. So if you have a big nest egg, in our example is $15, but if you start putting zeros behind that, it could be $150 or it could be $1,500 or $15,000 or whatever it is. And then you can basically just live on that with a guarantee return of your principal at the end of the term.
Amazing. I feel like we're getting into explain it like I'm 10 territory.
Yeah,
I feel like a 10-year-old could probably grasp that.
Yeah, some of it.
We're getting better. You're getting better.
Talk about strollers. Okay.
Talked about strollers. Very relatable for me, a childless spinster. Okay.